Good evening, all of you. Is my voice audible and is my screen visible to all of you?
Yes, Tanvi, I can hear you.
Okay, so let's proceed. Last time we had finished with net present value, and I was going to start with IRR, but then there was no time. So let's now start with internal rate of return, IRR. That means your internal rate of return. Now, this internal rate of return is basically the amount of, so it's like a rate of return only. What's basically a rate of return? Rate of return means something what you earn on some investment. So if I tell you I've got 10% return on investment, if I tell you okay, I've got 10% return on investment, that means I have invested, let's say 1 lakh rupees, I've got 10,000 on it. That is called as a return on investment. So return basically means your profit, right? And rate of return means the percentage of profit. Rate of return. Rate, right? Rate of return. So what is IRR? What is the meaning of this internal rate of return? It's more connected with NPV. It's a part of NPV, you can say, right? So it's basically a discounting rate. It's basically a discounting rate. Like all these things with discounting factors which we use, it's a discounting rate. Now, IRR actually in theory, IRR is that discount rate. I'll just copy it here. Is at discount rate at which NPV is 0. So if you use the IRR for your computations, let's say this 12% is not IRR because at 12% when we compute NPV is not 0, right? So when that IRR in theory is that rate of return, is that discounting rate at which NPV will become 0. That means the present value of inflows will be exactly equal to the present value of outflow. That means this should come at 4 lakh 50 only. So the rate at which we discount, right? At which we the for example this was 12%, right? So if I reduce this rate, for example, to 10%, oh sorry, I increase it to 15%, 18%, time will come when NP will become negative, right? Because the higher the discounting rate, the lower the NPV, right? The higher discounting rate, the lower the NPV. So if I keep on increasing this 15, 18, 20, a time will come when NPV will become negative. यहाँ पॉजिटिव आ रहा है नेगेटिव हो जाएगा, right? So something in between where NPV is zero, exact zero, that is called as the internal rate of return. That's your theory. But I can basically internal rate of return can be used to find out the percentage return in present value terms. The percentage return in present is the absolute amount. How much I'm gaining in present value terms, right? These were the future figures. I converted them into today's figures and then compared it with the today's investment to get the today's actual profit I'm making in today's purchasing power as per today's value of money, not as per tomorrow's value of money, right? So as per today's value of money, I am gaining 84,000 in today's value, right? So what's the rate of that return? That is called as that is normally what we use the IRR formula for. So it's very simple. IRR formula is very simple. But first of all, when can you use IRR formula? When when cash flows are occurring at even intervals. That means, see, 1 year. Every year also, if you see, it's at even intervals, either at the beginning of the year or end, but there's a gap of 1 year everywhere, right? Either beginning of the year or end of the year, but the gap of 1 year is there everywhere, right? So there's an even gap, 1 year, 1 year, 1 year. Whether you call it beginning of every year or end of every year, there's a gap of 1 year, so even intervals, right? So if the cash flows are at even interval, means equal intervals, then you can use the IRR formula very easily. What's the formula? If I want to compute the IRR of this part, this project one. So formula is, so see here, formula is IRR bracket open, right? Values. So you take all the values from your initial investment till your this one. This is for, sorry, I have to do it for end mode. So end mode was here. No? This is the end mode, right? So I just copy this thing again. I'll just make, oh, I'll copy it again. So I'll just copy this thing again. Here, this part, entire thing, just to illustrate to you. I'll just copy it from here, the entire thing. It, it, So if I want to compute IRR in end mode, right? These are the end of each year. So IRR is equal to, bracket open, all these values together. You sum them up like this, right? You have to make this range and then bracket closed. You get, if I just open up the decimal points, you get 15.396%. That is your rate of return in present value terms, right? In present value terms, that's the rate you have got. There is a physical formula for this, which is not so important at your level. At the college level, we do that physical formula, right? But at your level, it's not so important because you're going to do it on the calculator on the Excel sheet, right? Like in present value, annuity, all also for everything we have done till now, there is a physical formula for that, right? But we don't actually use the physical formula nowadays. We use the Excel sheet or the calculator. So that's how an exam also you do that way only. You don't need to remember the formula. But when you see have textbook with you, you can see the formula, but you can't solve it physically. That you need the calcium. Only the formula is there, but you can't solve it physically. It's has cube root and fourth root and all that stuff. So because raised to 24, raised to 18, you can't solve it physically. You need the calci or the Excel sheet for it. Right? So on the Excel sheet is very simple, but you have to do it in this way. This format should be there. 0, 1, 2, 3. This is like beginning of first year, end of first year, end of second year, end of third year, end mode mein. We are assuming everything is happening at the end of the year. So end of first year, end of second year, end of third year, and today's investment. What is going out, minus sign? What is coming in, plus sign? So if you have this format ready with you in Excel, then you can directly apply the formula of IRR and get the answer of IRR, 15.396%. That's the rate of return in present value terms. So when you're evaluating different projects, you compute IRR for each project. Like project 2 also if I want to compute, and project 3 also if I want to compute. So I'm getting the three different IRRs. So the project with the highest internal rate of return is the best project, obviously, right? So highest NPV and highest. See, highest NPV and highest IRR. They always give you the same result. They won't give you conflicting results, right? A project with the highest NPV will also have the highest IRR, right? Because it's the percentage term. This is in absolute numbers, but the concept is the same. In present value terms, how much you have earned, absolute amount, percentage terms. So 16.416, 15.889, and 15.396. Now, if I want to compute this on the this type of format, this one, this, I can't do it because then I have to do, it's not possible for me to do because all the cash flows are different. So there is no PMT here. There is no PMT here. There is no PMT here. But there is PMT here. There is PMT here. So I can try to find out the rate in this case. I can do it through this Excel sheet thing. Although I don't need to do it, but I can try doing it and get the answer of IRR through this because here there is PMT is there. So there is some shortcut available here to do. So let's say if I do it through this part, let's see whether we get the same answer or not for IRR. So let's do it through this mode. So we have now we are doing on the Excel sheet. So number of years are how much? Number of years are three, right? One, two, three. Rate is, that's what we have to find. The rate we have to find. Present value is minus 2,40,000. Sorry, minus 4,50,000. That's the amount we have invested today, right? The initial investment. Today's present value minus 4,50,000. PMT is positive 2 lakhs for 3 years. Every year 2 lakhs, 2 lakhs, 2 lakhs for 3 years. Future value is nothing because at the end we are not getting any lump sum amount, right? PMT, we are getting PMT every year. That's it. No other amount at the end of the period. And type is end mode because end mode. So end mode, I think zero, right? Type is zero. So if we do it and compute the rate here, rate, apply the rate formula, right? So first is NPR, PMT, PV, future value, type is zero, close bracket, get the answer, right? So if I just open it out, See, same answer we're getting 15. I'll just open one more decimal. 15.889, 15.889. So if PMT is there, that means same even cash flows are there, even cash flows. Then you can do this way also. You can do IRR directly. But if there's uneven cash flows, then you can't use this. You have to do this way. And because uneven cash flows scary, then you have to do for individual things and like average, very long procedure, not worth doing it, right? Because there we can't have a PMT amount. There's no PMT amount. Everything is separate, right? So you can't combine. But here you can combine. Yeah. And this you can combine because even cash flows, right? So this is the one way of doing when there's even cash flows, the IRR can be computed this way also, right? Or you can do this way. But for that, you have to have the data in this format, right? In order, one after the other, right? Then we can do it. So that's your IRR. Now, if I want to do the same thing in begin mode, right? If this investments are at the beginning of each period, if these investments are at the beginning of each period, then okay, before that, let's do it on the calci also. We have to do it on the calculator also. So in the calculator, we have this thing function called as cash function. Cash, right? For NPV also we had used it. For this also we will use it, right? So cash function we have cash. You press the cash function on the calculator. Uh, there must be somewhere here. Casio images here. It's a little blurred, but the other image is proper. So this is proper. So we have the cash button here. Cash. Right? You press the cash button first, right? You press the cash button first. It will it will open some table. Then first you have to enter I. You have to enter I here, right? So in case of I, you now I is not I do we don't have. We want to find out the rate, right? I we don't have. We don't have any discounting rate. We want to find out the rate. So I'm just deleting these information which was already there in NPV, so I can rewrite them. Okay, I'm okay. I'll delete everything. I'll delete everything. Delete everything. So it's not okay. So now we have this. Now first we'll do end, then we'll do beginning. So cash function will be put. We enter the cash one. Then for I you enter zero. Enter zero. Because I we don't want I do we don't have. We want to find out IRR, right? So let me do it along with you. Where's the calci one? Oh, let me do it along with you. So I also so if you have the calci with you in case, you can also do it with me. So first you press the cash button, right? Then cash button, you first they will ask you I. So you press zero there, right? Zero and execute, right? You have to press the execute button every time to go forward. Then the second option will be this cache the editor. Go on this and press execute. It will open a table, small table, this way, right? So one, two, three, four will be there. So in one, now we are doing in end mode now first, right? We are doing in the end mode. So in one, what we do, we assume in this also, like in the previous NPV, we assume then when we on the calculator, this one, two, three, four is beginning of year one, beginning of year two, beginning of year three, beginning of year four. That's what the calci is programmed to think. One, two, three, four means beginning of year one, beginning of year two, beginning of year three, beginning of year four. Whatever mode you are doing, this is the meaning of one, two, three, four on the calculator. So if I am in end mode, if I am in end mode, so at the beginning of year one, what's happening? I am losing 4 lakh 50. I'm giving 4 lakh 50. Let's do this part. I'm giving 4 lakh 50 at the beginning of year one. So minus 4 lakh 50,000, right? Then beginning of year two, that means end of year one. What is happening end of year one? 1 lakh 80 we are receiving. So 1 lakh 80,000. Then 2 lakhs and 2 lakhs 21,000. So whichever mode you are doing, right? Whichever mode you are doing on the Calci 1, 2, 3, 4 means beginning of one year, beginning of second year, beginning of third year, beginning of fourth year. So beginning of first year means zero. Today's time. So what happened that time? 4 lakh 50 went. So 4 lakh 50. Then beginning of year two is as good as end of year one. So we are doing this in end mode. So end of year one, what happened? 1 lakh 80 we received. So 1 lakh 80. And then 2 lakhs and 2 lakh 21, 2 lakhs and 2 lakhs 21. So 4 year means beginning of year four as good as end of year three. right? So 2 lakh 21, 2 lakh 21. So you press these. Let me also enter here. So minus 4 lakh 50,000. Sorry, 4 lakh 50,000. Execute minus 4 lakh 50,000. Okay, execute. Then there is 1 lakh 80,000. Execute 2 lakhs. Execute and fourth में है 2,21,000. Execute, right? So you have all the figures. Now you press escape button. After you enter all escape button now, press the escape button. You'll come back to the main table where this is there. You have finished this, then you go down, scroll, scroll. NPV will come. Ignore it. Ignore NPV. There's one after NPV. There's IRR on that same screen. So you go to IRR and press the solve button. You press the solve button on IRR instead of NPV. You press the solve button on IRR. So if you want NPV, you can press solve button on NPV. It will give you NPV. If you don't want NPV, just scroll down, come to IRR, and then press the solve button. So I press the solve button here, right? And it has given me an answer of the same thing, which was what was that? 15.396. 15.395666624 exactly. But the answer is why 15.396%. So solve it, you'll get the answer here. 15.396%. That's your end mode computations. Now, if I want to do the same thing in begin mode, that means I assume okay, this is not at the end of 1 year, this is the beginning of 1 year, right? I just change the mode from beginning to end, right? So if I copy the beginning table, just copying it again. Say actually same thing is there, but if it's in begin mode instead of end mode, begin mode. That means beginning of year one. This also beginning of year one, beginning of year two, beginning of year three. So then what we will do on the calculator, same thing you will do. Press cash button. I is zero, right? Zero execute. Cash editor में जाओ. Press execute button. First in the year one means beginning of year one. Now two things have happened beginning of year one. You have lost 4 lakh 50. You have gained 1 lakh 80, right? Because 1 year, if we assume in begin mode, 1 year means beginning of year one. That's as good as zero period only, today's period. So net amount we have invested how much? 1 lakh 80 we got, 4 lakh 50 we paid. So that amount becomes 2 lakh 70. So you write minus 2 lakh 70 at the beginning of year one. Then beginning of year two, 2 lakhs. Beginning of year three, 2 lakh 21,000. So 2 lakhs and 2 lakhs 21,000. And then fourth, nothing will come in four, right? And then you press escape, go to IRR, solve it, you'll get the answer in begin mode. Now let me do it. I've not done it in begin mode, right? So let me do that in begin mode. So I go to cache editor, this one, cache D editor, and in the first slot I have to enter now minus 2 lakh 70,000, execute, then 2 lakhs. The second, this one, 2 lakhs in beginning of year two, execute, and then 2 lakhs 21,000. Execute, escape, I come outside, escape, I go to IRR and I press the solve button, right? So let me see how much I'm getting here. I'm getting the calci takes some time to process it, so don't worry. And it will take about 2 3 seconds to put the answer out, but it will get the answer. So I am getting some figure here. Now let me check it with the Excel sheet, whether I'm getting the same thing with Excel sheet, right? So I'm just copying this entire format, right? Format again here down, so I can compute it in begin mode. I'm just changing the end mode to begin mode here. Now, what's the difference in IRR formula? Excel. Now, here the formula was very simple. IRR for just take the range from year to year. But now the problem is कि you can't directly take the range because what is happening? कि if I am assuming it's at the beginning of every year, so that means I have to change the table little bit. So it will be like 0, 1, 2, 3, right? So what is happening at the beginning of year one or zero period? There are two transactions happening now. If we take it in begin mode, there is money coming in and there is money going out also, right? So what do we do in zero time period? I have 4 lakh 50,000 going out. and I have 1 lakh 80 coming in because we are assume it's the beginning of year one. Zero means beginning of year one. So beginning of year one, we have 1 lakh 80 coming in, right? So that's then at the and then next year we have 2 lakhs coming in, and then 2 lakh 21 coming in the third year, right? So this nets off to this plus this 2 lakh 70 in the first year. So same way we had made the table here, we make the table again in Excel sheet here, and then we apply IRR. So IRR, take the range, open it out, 34.80. So almost double, right? Almost double, right? Here we had got how much? We had got originally we had got 15.396, and here we have got 34.80%, right? So a huge difference when the mode changes, because last time I had told you, okay, why the difference is happening, because even the NPV, if you see, it has more than doubled in the in the begin mode. Sorry, I copied the wrong thing. This is the begin mode, so I'll copy this one. Okay. I'll copy this one, this NPV here. So, wait. See, even the NPV has gone 91, 88, 84. In end mode, it was just 27, 30, 33. So NPV has doubled, more than doubled. And even the IRR from 15, 15, 16 has gone up to, this is now 34.80. If I do the same for the other years, let me do it for this project one. Now project two, project two, and project three, right? So in project two, what we will do, 4 lakh 50 minus 2 lakhs. That means minus 2 lakh 50 in the first year, and then 2 lakhs and 2 lakhs. And the last third one with 4 lakh 50 goes out, 2 lakh 20 comes in. So in the beginning of first year, we have 2 lakh 30 going out. And then we have 2 lakhs and 1 lakh 79,000. These two, right? 2 lakhs and 1 lakh 79,000. So now this one, 2, 3, 5 written. Okay, let me make it easy for you. The one, two, and three. Then beginning of year one, beginning of year two, beginning of year three. So beginning of year one, two things are happening. Something is coming in, something is going out everywhere. So we take the net figure, and beginning of year two and beginning of year three, simply copy the figures as they are, and then you compute the IRR. So you copy it like this. In always the highest NPV will give you the highest IRR, even both the modes, begin and end mode, right? So whether you follow begin or end mode, the NPV and IRR will evaluate the same project as the best project. So which is the best one here? This one, project number three.
Has the screen been stuck? Hello?
Okay. So sometimes the company has a cutoff rate. Okay, you have to select those projects only which have a higher IRR than a particular set criteria. So this IRR is useful at that point. Because what happens normally, see the reason for IRR being a better measure is because it's a percentage measure. It's a percentage measure. So sometimes absolute amounts are difficult to compare. They are difficult to compare. Why? Because sometimes what happens, okay, let's say some project requires only lakhs of rupees. Another project requires 10 lakh rupees, right? So because the amount is big, the NPV will be higher, right? But that doesn't mean the NPV is better. Because just because the amounts are big, right? That project requires big amounts. So the NPV will be obviously a higher amount as compared to a project which has small amount of investment required. But the percentage figure will give you a comparable thing, right? So for example, if I tell you, okay, let's say you have two exams. One exam is of 500 marks, other exam is of 400 marks, right? So let's say A is there and B is there, A and B. So if A scores, let's say, to 300 in this exam, oh sorry, he scores 400 in the exam, and uh, B scores 380, right? So if you see in absolute terms, A is higher, but percentage wise, B is better, right? He is more near the target. A is more farther away, right? 380 and 400. I'll make it, let's say, I so maybe that's not the correct example. 350, I tell you, and let's say 340 here, maybe, right? Maybe you'll get a better percentage. But the point I wanted to explain here, okay, you can't compare 350 and 340 because 350 is out of 500 and 340 is out of 400. So here you will get, let's say, around maybe 70, 75, 80%. How much do you get? 340 divided by 400, you will get 85%. And here you will get 75%, I think, right? So if you compare percentage wise, B is better because B has scored a higher percentage. But if you compare the marks, A will seem to be better because A has got more marks. So there's something like that. This is NPV. Just because the amount involved is higher, the NPV will be higher. But that doesn't mean NPV is better, right? So IRR is a better measure because it makes all the projects comparable by converting the NPV or the present value returns in percentage format. So percentage you can easily compare with each other. Absolute amounts you can't compare with each other, right? So IRR is a better measure for ranking the projects. For ranking the projects, you can't just see NPV and rank them, right? Because NPV may you have to check whether the investments are equal. If the investments are equal, then you can compare NPV. But if the investments are not equal, then you can't compare NPV. You have to go for IRR, right? So that's why IRR is a more reliable measure for ranking the projects because it just condenses the answer into percentage format, right? Which the other measure, NPV, is not able to do it. Now, IRR is not only useful for NPV. NPV may this IRR is good, and if I find out that level of IRR at which NPV is zero, that becomes my break-even point. That becomes my what? Break-even point. So let's say I get about if it's 12%, let's say at 15 point, assuming 15.51%, if I compute this thing, right? Compute this entire thing at 15.51%, NPV comes to be zero. Let's assume the NPV comes to be zero or 0.5, 10, 20 rupees maybe, right? So that IRR, this 15.51, becomes my benchmark, right? Okay, any project having a discount, having a rate of return above this is to be accepted, right? Or lower this is to be accepted, something like that. This becomes like a mid figure where NPV is zero, right? So zero NPV is like a benchmark, your break-even point. So if the NPV is below zero, the project is to be completely rejected because it's giving a negative return in present value terms, right? Maybe in absolute terms it's giving a positive view, but in present value terms it's giving a negative return. So that becomes your break-even point sort of thing. So that also is helpful in your evaluation of projects. That level of return at which NPV is zero, right? So ideally, the book definition of IRR is that level of return at which NPV is zero. But IRR formula is used for computing this rate of return also, which because we can't use this box for that, right? This rate, we can't compute rate in this way for uneven cash flows. So we use IRR formula to compute uneven cash flows, right? For compute the rate in case of uneven cash flows. So now let me give you one more example where you will see the actual practical use of IRR in your own personal life. Right? Let's say you have an insurance policy, insurance policy, which tells you, okay, for 12 years you invest 2 lakh rupees every year, right? So 12 lakh for 12 years, right? So I'll just do one, two, I'll just stretch it down. 12 years, 12 years, 12 years you keep on investing 2 lakh rupees every year. Insurance premium, life insurance premium, something like that. And then after the 12th year, from the 13th year, for 12 more years, for 12 more years, 24th year, you will get 2,50,000 rupees every year. That means you have to pay only for 12 years. And for next 12 years, you can enjoy your money along with 50,000 extra. So you pay 12 lakhs, you receive back how much? 30 lakhs. Right? So you pay 24 lakhs, you receive back 30 lakhs, right? So 6 lakhs profit. That's what the policy claims to give you, right? So uh, maybe some person may be impressed by such a policy. Okay, you are paying only 12 lakh rupees, but you're getting back 30 lakh rupees, right? So now you know, okay, this is the time where your money thing, and you are paying money for first 12 years. So they're using your money for first 12 years to do whatever they want. And then after 12 years, when they have used your money, then they're paying you back, and definitely they are paying you less than what they have earned with your money, right? That you understand as a person. Okay, obviously they will also see their own profit. But if I want to compute the present value terms rate of return, the rate of return in present value terms, I use the IRR form, right? And I just do from year to year the entire range, right? And close the bracket. I get an IRR of how much? Hardly 1.88%. So in present value terms, you are earning only 1.88%. That's even lower than a savings account, right? Even lower than a savings account. Because you may think that you're getting 6 lakh rupees, right? You're getting 6 lakh rupees. But actually, you're not getting anything. Only 2% in present value terms. That means your value of money today, in today's terms, you're earning only 2% of the value of money you have. Better you put this amount in a savings account and earn 4 or 5%. That will give you better returns, right? Let's take another policy. Let's take another policy. Same thing, same idea. 2 lakhs at the end of same thing. 2 lakhs for every year for 12 years, right? 2 lakhs for every years for 12 years. Then they say, we will give you 1,50,000 for next 12 years. Okay. And then they will give you 1,50,000 for next 12 years. And in the 25th year, they will give you your 12 lakh rupees back also. That means that, sorry, your 24 lakh rupees, they will give you back. That means what you have invested, this 24 lakhs, they will give you back in the 25th year. Plus, they will give you 1 lakh 50 every year for 12 years. So now let's compute IRR and see how much you're getting. I have to modify the formula because it's not going to capture the last column, right? Last row. I have to just make it 26. The range I have to make it 26, right? So now I compute. So 3.64. So it's a little better, but still not so good, right? Little better, but still not so impressive. Only 3.64% in present value terms, right? That's hardly anything, right? So again, you can reject this policy, right? If you should get more than your interest rate in the market, at least, right? Because interest, if you put this on interest, you'll earn every year 4%, right? And it will be compounded every year, right? So it will grow with your money. So what's the use of doing this policy, right? So nothing much is happening here. The only thing is maybe if you're retiring after 10, 12 years, so maybe after that you'll get every year 1 lakh 50, and then in the after 12 years you get 24 lakhs back. So, but this 24 lakhs you're receiving at the end of 25 years. So the value of money is going to be much higher than the very, today's 25 lakhs and after 25 years, 25 lakhs. There's going to be a drastic change in the value of money, right? So, so it's not actually going to be useful to receive after 25 years. So such policies are there in the market. Maybe they won't give you 3.64, they'll give you 4, 5, 6%. But in the end, you have to check it like this, right? And you check this along with the present day FD interest, PPF interest, that is higher. 7%, 6%, 5% you're getting. 10% FD is also available nowadays. So that is much higher than this for a policy thing. You will be getting life cover for along with this, right? They are giving you life cover also, insurance also. So if that's your objective to take insurance, then it's a good thing. But if it's purely for an investment motive, then it's not worth doing this kind of investment. So what is your objective actually? If it's insurance, then it's something good. Along with insurance, you're getting your some return also. But only if it's for investment, then it's not used getting such a policy. So these are examples, right, of various policies available in the market, right? And let me tell you one more thing. One more thing. Let me give you one more example. I'll show you how you can why this IRR is higher, lower. Let me give you one more example. Let's say 1 lakh every year. Now, see, when you are doing IRR, you have to do minus and plus sign properly, otherwise it will go wrong. So minus sign for the first 12 years because you are investing money, and plus sign for the next years because you are getting money, right? So that be very careful of the plus minus sign. And these are even intervals every year, end of every year or beginning of every year, whatever the case is, right? But the intervals are even 1 year, 1 year, though only then you can use the IRR formula, right? So although the cash flows may be uneven, but the intervals are even. After every gap is 1 year, 1 year, 1 year, consistent gap, then you can use the IRR formula. Now let me give you that example you're talking about. One minus 1 lakh
Sir,
for 12 years.
sir,
Yes.
if the interval
Tell me.
is of 6 months, then also it is okay.
Come again.
If the interval is not of 1 year but 6 months,
Still is okay if it's a even interval. But then what happens that we have to do that half yearly, nominal into effective. We have to do that way. But then even intervals are, if it's even intervals, it becomes like a PMT. If you what you're saying, if it's
yes,
PMT means equal intervals also and equal amount also. Then you can use the PMT, that table, right? Equal intervals also and equal amounts also. But amounts are not equal, but intervals are equal. Then you can use the IRR formula. It can be 6 months also, 1 month also, 1 week also, but it should be an equal interval. That's the condition for IRR to be used. If the intervals are unequal, 1 month, 2 months, half month, then you can't use this IRR formula. Then you have to use this one, which you're going to do after this,
yes,
XIRR, right?
understood.
That we will use. If the in what case? Uneven cash flows and uneven intervals. Both are uneven. Cash flows are also uneven, intervals are also uneven. Then we will use XIRR, right? Your cash flows are uneven. 2 lakhs is also there, 2 lakh 50 is there, 24 lakhs is there, uneven cash flows. But intervals are equal. 1 year, 1 year, 1 year, 1 year, 6 months, 6 months, 6 months. The intervals are equal. Then you can use IRR, right? So that's your differentiation factor. We will do monthly sums also later. So don't worry. So when we do that, your doubts will be cleared. But the doubt was valid. The intervals can be 1 year also, 6 months also, 1 month also, half year also, but equal intervals. That's the condition for using this formula. So let's say 1 lakh. Now I'm doing for 1 year only, right? Minus five, because I don't want to include that complication of 6 months here. So until you we get this concept straight. So minus 1 lakh for 12 years. I'm taking a simple figure of 1 lakh, so it's easy for us to analyze afterwards. Then every year you are getting, let's say, 2 lakhs back, double amount, right? Double amount back for rents. So first you compute IRR for this. It comes to around, I think it will come not much, 5.95%. Now there's another scheme where you have to invest the same 1 lakh for 12 years. Now, when in practical life, when you're comparing schemes, you can do this way, right? 1 lakh, sorry, 1 lakh again for 12 years. And then they will won't give you 2 lakhs, they will give you 1,25,000 or 1,30,000, right? Every year for 12 years. And in the end, they'll give you back the initial 12 lakhs which you had invested, right? So there are two schemes here which you need to evaluate, right? This scheme, both the schemes require you to invest 12 lakhs in the initial 12 years, right? I've had just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 years. And then The first scheme will give you 2 lakh every year for next 12 years. This scheme will give you 1 lakh 30 every year for next 12 years, and then 12 lakhs in the end. So if I compute the IRR for this scheme, right, copy the formula and paste it here, it's giving me 5.85, which is lower than this one, right? You will say, sir, why is lower? Because if I just take the entire summation of receipts and payments, I am gaining 12 lakhs here. See here, 12 lakhs. Because I'm first I'm paying 12 lakhs for 12 years, then we're seeing 24 lakhs over the next 12 years. So 12 lakhs I'm gaining. And here, if you see, just adding up everything, you are gaining 15 lakhs 60,000. So you're getting more money here, right? Because you're getting this 12 lakh also in the end, plus 1 lakh 30 every year for 12 years. So you're the positive thing. The profit you are getting is 15 lakh 60. The profit here is absolute terms 12 lakhs. Profit here is 15 lakh 60,000. So why is the second scheme giving you less IRR? That's the question that you should be asking. Okay. The first scheme is giving you only 12 lakhs profit, right? You invest 12 lakhs, you get 24 lakhs, 12 lakhs is your profit. Second scheme is giving you 15 lakhs 60 as the profit because you're paying 12 lakhs and you're receiving 1 lakh 30 for 12 years plus 12 lakhs back. So this entire thing of 1 lakh 30 for 12 years is purely profit only because what you invested earlier, you got it back at the end. So this 15 lakh 60, 13, 1 lakh 30 per year is pure profit for you. So still, the second scheme is giving less returns as compared to the first. So why is IRR lower in the second scheme and more in the first scheme? Can anyone tell me? Absolute profits are more in the second scheme. You're earning 15 lakhs 60, and here you're earning only 12 lakhs. So as a layman person, you will say second scheme is better because it's giving you more amount of profit, right? But as a CFP or as a financial consultant or as a professional, what you will say the first scheme is better. Now, what's the reason for this reasoning? Okay, why is the first scheme better? The reason being is the first scheme is giving you higher amount in the earlier years. If you see this part, 70,000 extra you're getting here in this year, in the 13th year, 70,000 extra. So that means more money you have. Now let's say you invest this 70,000 at 6% interest in some savings account or somewhere. This will grow to how much? This will give you interest of 17 to 6%. Let's say it, sorry, undo. I'll just insert one more column in between. So it will give you into this into 6%. Let's say 6%. Same rate for 5.95 है ना तो 6% same interest rate you are investing. So you get this much interest. Then again next year you get 70 extra money. So this becomes, so now you have 70 plus 4 plus 70. This also you invest. So you get 6% on 1 lakh 44 200, right? 6% because 70 plus 70 plus 4,000 1 lakh 44 200. You earn this much interest. So by the time you reach here at the end, you not only have this 2 lakh rupees every year, you are getting here also. You are earning money on this front also because you are receiving extra money here, 1 lakh 30 as compared to 2 lakhs. So 70,000 extra, which you can reinvest and earn more money out of it. So that's why the first scheme is better because it's giving you a higher return in the initial period. This extra 70 every year, you can reinvest and earn more money out of it. That that will give you, that's why the IRR is more in the first case, right? Because it will give you, it assumes okay, if you have this 70, you will invest at the same rate in the same policy or same investment and you will get more money out of it. That's why the internal rate of return is higher in the first case, right? Because you are getting more money initially, right? So that extra money which you're getting initially, you will invest in some other scheme on the same type of scheme and earn more money out of it, right? So that's what they are. So that's what's happening. So the question here is because the time value of money is falling with time. So the quicker you get your money back, the better. Right? So the 70,000 at the end of 13th year, 14th year, 15th year, you're getting it back earlier, right? Here you're getting it at the end of 25th year. So by that time, from year to year, the value of money is falling much more rapidly every year, right? So that the later you get the money, the lesser the value of that money is. So if someone tells you that he will take a loan from you of 1 lakh rupees and pay you after 3 years, the same 1 lakh rupees. And the other person tells you he will pay you within 1 year. So the person who is paying you within 1 year actually is getting you a better value than the person who is paying you after 3 years. Although you're getting the same 1 lakh back. But the 1 year person is better than the 3 years. because after 3 years, the value of 1 lakh will be much lower as compared to value of 1 lakh after 1 year, right? So the more late you get it, the lower the value of that money becomes, right? So that's why this IRR is higher in the first scheme. So whenever now in life, when you have to evaluate the investment option, you do it this way, right? Even your salary, anything, if you want to evaluate how much return you're getting in present value terms, right? So you can do it this way. This requires only inflows and outflows and a time interval of which is equal time intervals. So maybe approximate figure you can find out, right? If it's anyone comes with you with a policy or something, you can do this way and find out the answer whether you should invest in the policy or not. Compare this IRR with any other investment option which you have today, which is giving you, if it's giving you more percentage than this, then you should go for that and not this. Right? So basically, you have to compare different investment options. The highest IRR wins, right? So that's why we are doing all this. This is your, but the problem here is we have to have equal intervals. In real life, sometimes insurance policies possible, equal intervals very much possible. But mutual funds, shares, difficult because dividends are not paid on equal intervals. Dividends are not paid in equal intervals. Sometimes they are paid quarterly, sometimes the amounts are different, dates are different, right? Every year, same date per dividend, you don't get it. Equity dividend. Sometimes it's June, sometimes July, sometimes August. Sometimes they pay interim dividend also during the year, right? So dividends are fluctuating in value also and in time also. So for that you need XIRR. You can't use IR that even in mutual funds. Mutual funds also give dividends, right? So that dividend also not consistent. Sometimes in December mid they give, sometimes they give it in January, sometimes in November, right? So the intervals are not actually exactly same every time. Sometimes they don't give. Some companies don't give dividend 1 year, right? Then they give it next year higher dividend. So in case of dividends, where dividends are there, difficult to apply IRR. You have to use an XIRR for that. But in case of consistent equal interval things like interest, insurance policies, not EMIs. EMI is not return, it's a payment. IRR is normally used for how much we are earning because the name is internal rate of return, not of payment, right? So normally we use it for how much amount we are earning out of something. That's normally the logical way of using it, right? So normally for insurance policies, for your FD investments, you can use that, or for any other scheme which requires you to pay or receive money at regular intervals, whatever the amount may be. Because uneven amounts, okay, intervals should be even. Intervals should be even. Now, what if they are uneven intervals? How to use the XIRR formula, right? Now, I don't know what X means, right? I have to Google it, right? I think it's just an extension to understand. Yeah, X means uneven intervals. Right? Means here suggests the name extension of IRR formula for uneven intervals, right? Not even uneven intervals. So before I go that way, before I go that way, I I don't remember where I was. I had one more example for you, but okay, if I remember it, I'll do it. Let me go for further now. So let's say on 1st of January 2022, you invested 4,80,000. Okay, let's say in shares of a company or in mutual funds. Then on 15th of February, sorry, 15th of February 2023. Okay, you receive some dividend of 1,80,000. Right? I'm just saying big figures, lots of zeros. So the answer is also in, we are able to easily see the answer. Right? Then on 15th February 2023, received dividend. Then on, let me give a 20th of May 2023, he again, or let's say 2024, right? 2024, he again, received some dividend of 2 lakh rupees. Okay. And then let's say on 1st of January 2025, he sold that amount, right? Sold the investment for how much can you sell it for? Let's say 8 lakhs, 4 lakh 80,000, 6 lakhs. Okay. So these three are receipts, dividend, and sale value. This is the purchase cost. So minus. Now, and these are dates. Now, dates ka format, you have to ensure okay, it's in date format, right? See here, you can see date format, right? Date format. If it's not in date format, it will be aligned on the left hand side. Let me give an example. If I write something like this, which is not in date format, it will be left aligned, left aligned, right? So in the exam, if you're doing a Excel sheet, if the date is going on the left side, that means it's not in date format. Then the formula won't accept it, right? So just ensure it's in date format. Now in the exam, there'll be open office, not Excel. Open office will be there. So in open office, sometimes what happens, okay, the computer, you go to a center, if you're going to a center, if you're doing it at your home only, then no problem. But if you're going to a center, then that computer may be programmed to take the dates in other formats. Like there are for dates, there are many formats available in the Excel thing. If I just go here, see if I go for format cells. So there are many formats of the date, right? You can see here, right? English, United, South Africa. So normally it's set in the USA type of format. That's month, date, and year. Month, date, and year. Normally, sometimes it's set in that format also. So whatever format it is, you have to ensure that all of them are the same consistent that format. ऐसा नहीं हो कि यहाँ पे date month है, यहाँ month date है. That if that happens, then you the answer will be wrong, right? So it should always, if you are doing date, month, year, then everything should be date, month, year. Otherwise, month, date, year, right? So just ensure that all the dates are in the same format. Upper niche, it doesn't get in the wrong format. Otherwise, if it becomes like from if it's 1 February, it becomes 2nd January by mistake. 1 February becomes 2nd January. So the formula will give you a different answer. It won't give you the correct answer, right? So just ensure okay, the dates in the question are same as the dates you have written here, right? So that when you do an Excel, you come to know okay, when you're doing the wrong dates and right dates. Because sometimes what happens if the date is in month format, it won't accept more than 12 in the month area, right? So all these things so you have to that you have to practice on the Calci or on the Excel sheet, and this formula is not available on the calculator. XIRR, right? So you have to do it on the Excel sheet. So XIRR. First, you take the range of values. Okay. Then you press comma. On the open office, instead of comma, you have to use semicolon. Right. Right. And then you have to set the dates like this. Right. So first take the range of values, then take the range of dates. Close the bracket. You get now this is not a general format. If I change it to percentage format, it will become the percentage. 33.80%. That's your XIRR for this thing. Right. So this is the formula we use when the cash flows are uneven and the dates are also uneven. That means there is no fixed interval. Here the interval is of 1 year, 1.5 month, then 1 year, 2, 3 months, then again. No, so there's no fixed interval of 1 year, 1 year, 1 year, 1 year. Right? It's a varied interval, completely haphazard here and there. Right? So that way you can compute the XIRR. So when the frequency is even, you use IRR. When the frequency is uneven, you use XIRR, right? XIRR. So the amounts are big. That's why because if you see the returns are very high, right? 1 lakh 80, 2 lakhs, 6 lakhs, and only 4 lakh 80 investments. That's why I'm getting a higher amount of 33.80%, right? So if I just make it a little more logical, right? So I make this, let's say 2 lakh 20,000. Then I get a logical figure 10.66%, right? So you can play around with the figures and just get the different XIRR, right? That's the beauty of Excel sheet. You can just, once you have the formula in place, just change these figures, you get the different answer every time, the right answer every time. Right? So that is your XIRR. So whenever the frequency is not even, uneven frequency, right? Periods, the gaps are not even, then you have to use the XIRR formula. You can't use IRR, right? In that case. So that's what about this uneven frequency rate of return. Let me give you one more example for this XIRR. Right? So in, let's say, in 2015, let's start from 2020, 20, 21, 22, right? So, oh, I have to, sorry, dates. The 1st of January 2020, right? Then 31st of March 2020. Okay. Then 15th of June 2022 कर डालते हैं, right? Then 20th of December 2023. Okay. See now I've written different formats, so it's not coming. I've only 2003 have written, right? So now it came properly on the right side. And then March 2023. Sorry, 24, right? 24. So this is the dates available for us, right? Now in on 1st January he invested, let's say invested how much? 10 lakh, 10 lakh rupees in some share, okay, or in mutual fund. Then 50,000 he received as dividend on the 31st of March 2020. Then 75,000 dividend on 15th of June 2020. Then 1,25,000 dividend in 2020, December 2020. And 31st March 2024, he sold all the shares. So dividend, dividend, and then sold all the shares for 1 lakh, 18 lakhs, right? 4 years he stayed invested. For 4 years he was invested. Then he sold it at 1 lakh, 18 lakhs, right? So what is the XIRR? Yeah. So you see XIRR can be over multiple years, right? Because the dates are there. So you don't care whether it's monthly difference, yearly difference. Dates should be there. That's it, right? So यहाँ पे monthly, yearly doesn't make difference, right? Because all it goes as per the dates available in the, so XIRR. First, what you will do, you take the range of values. First, comma or semicolon in case of open office, and then range of dates, right? And then close the bracket, and you get the answer as uh, percentage format. I'll convert 19.57 percentage, right? That's your percentage of return over the course of 4 years, right? In present value terms. In present value terms. Now, if I just add one more investment in between, let's say 15th June, so on 31st of December 2022, he further invested. Let's say invested, oh, sorry, sorry, something is happening. Minus 2 lakh rupees, right? 2 lakhs, right? So let's say further invested 2 lakhs, so I have to put minus sign again. So see the returns have lowered because you have put in more money. So returns have lowered, right? Because now more investment is there. So that way you can play around with this thing. So, and the date should be proper. That's the important thing here. Date should be exact in the same format, right? If one date is wrong, let's say I make some error here. I write, I write 20 only. See, error आएगा. It won't give you the right answer, right? So you have to ensure dates are in correct format and all are right aligned. Dates are always right aligned by default. Left aligned नहीं होना चाहिए, right aligned, right? So the dates are in the correct format. If they are left aligned, that means they are not in the date format. They may look in date format, but they're not in date format. If they are left aligned, they should be right aligned. Right? That was about XIRR. When the intervals are uneven, that case you have to use the XIRR formula. Otherwise, you use the IRR formula. Now, let me give you one more example of a question. Right. Now we are going on to loans now. Loan amortization. How to account for loans. Before that, some one or two warm-up questions just to make you familiar with what is going to come. Right. So let's say return of a fund is 12% per annum. Monthly compound. If R is to accumulate 1.5 lakhs in next 5 years, how much should he invest in the fund on every first of the month? Right? This is a question. I know it's a slightly repeat type of question, but we are going towards that. So let me one or two sums just to make you remind you of what we had done earlier, right? So return is monthly compounding. We have to accumulate 1.5 lakhs in next 5 years. That means your future value is 1.5 lakhs. You have to accumulate 1.5 lakhs in next 5 years. That's your target. You want this much money. So how much you should invest every month? On the first of every month. So it's begin mode. First of every month means it's in begin mode, right? So if I just copy that, what we used to use, the same thing, right? Right. In Calci, we use the CMPD function button, and then this table opens up. So this is only for Calci, right? This is Calci, this is calculator. These two are calculator, right? And type is for Excel only. Where's type? Type is not there here, right? Let me copy it from above. There's a ready-made. We have it there. Where has it gone? See this. Right, so this we'll copy this from here. I freeze the first column, so it's the same. So we have this. Now whatever is relevant for Calci, we put for Calci. Whatever is relevant for Excel, we put for Excel. So remember, this formula is not there on the calculator. XIRR can only be done on the Excel sheet. It's not there on the calculator, right? So then we get to come to this. Now we know okay, it's the beginning of each month, right? So on the calculator and on the Excel sheet, right? So Excel sheet में begin mode है, so type 1 and here it will be set to begin mode. Set will be begin on the calculator. Excel sheet type will be 1 because it's the first of every month. So basically it's a begin mode question, right? Then NPR, number of months I need because it's sorry, we need how much we have to invest every month. So we have to convert number of years into months. So 5 years into 12 into 12, 60 months, right? 60 months on Excel sheet, right? And 60 months on calculator also, right? Rate we have 12% per annum monthly compounding. So it's already 12% per annum monthly compounding. So this is the nominal rate of interest. It's already a nominal rate. Just simply divide by 12 divided by 12. You get 1% per month. Rate is 1% per month because it's a nominal rate given to you. Simply you can divide by 12 and get the monthly rate of interest or of return. PV is nothing because we don't have to, we are not investing today anything. PMT, we have to find out how much should he invest every month. So PMT, we have to find out. Future value, we need 1,50,000. 1.5 lakhs we need in 5 years. So future value needs to be 1,50,000. These two are not there on the Excel sheet, only on the calculator. So I use the PMT formula here. PMT, sorry, equal to PMT rate. Now, whenever I'm using comma here in the open office, you have to use the uh, semicolon, right? Say open office, it will be using semicolon, not comma. Then future value and type, right? Okay. Now, why is this coming to be? Uh, just a minute. Why? Just tell me why the error is coming. Anyone can point out something I missed out to write somewhere, right? That's why it's not coming properly. The mistake I've done or something I missed out is writing one as one only. It should be 1%, right? That's it will be a 1818. So that's amount you have to invest every month. 181818 every month. So you get 1,50,000 at the end of 5 years, right? At this rate of interest or monthly compounding 1%. Now, if I want to do this on the calculator, right? So calculator, we can use the same, just the rate which is given, 12%. In the Calci, don't write percentage, only 12, right? PV is 0, future value is 1,50,000, Type is not there in the calculator, but PY is there. Payment is 12 times a year, compounding is 12 times a year because every month you're going to pay and monthly compounding, so 12 and 12. You go here, press solve button, you will get the same thing as 1818 as the answer. So 181 is the amount you have to invest at the beginning of every month if you want 1 lakh 50 at the end of 5 years. Right. So that's how you can plan your future goals. So tomorrow, if you want, for example, 10 lakhs for going abroad, so you start planning from now, how much I should invest. And let's say 10% per annum as interest, FD interest, right? So and you start investing in FD from today or from in any other investment option which is giving you 10-12%. And after 5 years, you'll have around 1.5 lakh rupees if you do 1818 rupees every month. So small steps give rise to big amounts, right? So doesn't you won't realize also how fast your amount will grow. That's the power of compounding for you, right? Monthly compounding is very fast, right? So if you are going for monthly compounding option, then it is going to grow very fast, your amount of investment. Every month is being compounded. Na? That's why the compounding effect is 60 times. 60 times compounding is happening in 5 years, right? 60 months, so 60 times your compounding is happening. That's giving a rise to a very fast growth in your money. Right? So that's one example which we. Oh, now one more thing, another one. Right? Say Raj wants to accumulate rupees 30 lakhs for his son's education. If he has 1 lakh now, only 1 lakh he has now, right? He wants to give 30 lakhs, 1 lakh now, and expects 10% return. 10% return, right? So how much should he invest on first day of every month for next 10 years? Similar kind of question, right? I'm purposely put this question now. I'm going to twist it after this, right? So 10 years, right? Just, just how much should you invest at the end of just cut it here, paste it here, right? So I'm just copying this thing again, right? Okay. So Raj wants to accumulate 30 lakhs for his son's education. If he has 1 lakh now and expects 15% return, how much should he invest on the first day of every month for next 10 years? Now, first day of every month again is there, so begin more. Besides, even if it's not given, we will take begin mode only because investments we assume begin mode, right? So set is begin and type is 1. 1 means begin, 0 means end, right? So NPR for this is how many years? Now he wants to invest every month. So 10 years will be converted into months. So 120 months, right? 120 months is your first thing. Then rate, how much is rate? 15% is there only given. So we have to assume what? Yearly compound. Nothing is given. So yearly compound. Now, if it's 15% yearly compounding, this becomes the effective rate itself. So we have to convert into nominal rate. Nominal 15%, 12, because every month we are investing. So it becomes 14%, but that's not enough. I have to divide this by 12 also to convert into monthly rate. Only nominal rate we can divide by 12. So first we convert effective into nominal and then divide by 12. So we get around, let me expand this bracket, uh, 1.17, 171%. So that's approximately 1.1171 percentage rate of interest we get per month. Present value is nothing because the present value is there. He has 1 lakh now, right? So 1 lakh he is willing to invest now. 1 lakh. Yes, the present value. Then what is the future value? He wants 30 lakhs. 30 lakhs is the future value, right? 1 lakh is going to invest now. So it says minus sign, right? 30 lakhs he wants to get after 10 years. That's in plus sign. And PMT we have to find out because that's what they're asking us to find out. I'll copy the formula from above. paste it here. So I can get that figure of $9,868 per month you have to invest from today. Today you have to invest every day, every month, 9,868 rupees. So at the end of 10 years, you will accumulate 30 lakhs along with the today's 1 lakh. So 1 lakh of today plus 9,868 every month. That will give you 30 lakhs after 10 years, right? On the calculator also, same way, 120 months, but you'll take the rate as it is 15 percentage. No, only 15 for the calculator, 15 only. Present value is 1 lakh, future value is 30 lakhs. Time is not there on the calculator. Payments per year is 12 because every month he's investing. But compounding is only once because it's yearly compounding, right? So one. So now you apply the formula here. Go to PMT and press solve. You get 9868 as 317. Right? So that's how we will do. Now, if I just change this, if I just change the sentence, say sentence, I
Sir,
change the sentence.
sir,
Yes.
if
Now
it
tell me.
is, if they are taking investing every month, should not the compounding should also be the every month?
Yes, that's why we've taken 120 months. Compounding is yearly.
No, why?
Compounding is yearly.
When we invest something, then it automatically will be compounding, right?
No, no, it's not automatically. The bank will compound the computer interest every year then, not every month, right? So that's how when you compute the interest is important. So that's why it's only once a year it will be compounded. That means the interest will be credited to your account only once a year, not every month. So every month the interest won't be computed. Only once a year it will be computed. That's why yearly compounding. Monthly means every month the interest is computed, added to your principal amount. Then again
Hmm.
next month interest computed added to your principal amount. Again, that's how it happens. Yearly may interest is computed only once a year, 31st December, 31st March, and that interest is then added to your amount, principal amount, and then next year again after 1 year interest is computed.
Means
So the
the
bank is paying interest every only once in 1 year, right? So the compounding event is happening after 1 year, not every month.
so
That's why it's yearly and
if
monthly compounding.
if I'm investing every month, then whatever from January to December, all the money will be added up, and then total amount, the it will be compounded, right?
Like in PPF, something like PPF. If you invest in PPF, its interest is computed on 31st March every year on the balance that is there. So on 31st March, let's say, every year the interest, this will be computed proportionately. Like for what you have invested for 1 month, interest for 1 month. What you have invested for, let's say for January, you have invested. So on
Mhm.
that January amount, you will get 12 months interest on December. For February amount, you'll get 11 months interest in December. For December amount, you'll get 1 month's interest in December. But the interest will be added in December. So over the year, the interest won't be added to your principal amount. So the compounding effect will happen only after December, not during the year. Something like this. 10,000 you have invested in January, right? And then 10,000 in February. Let's take 2 months. And let's take 3 months. And 10,000 in March, right? 10,000 in March. Okay. So let's say yearly compounding is happening. So interest, let's say, how will interest be computed? Let's say interest is 10%, 10% per year. So 10,000 into 10% into 3 by 12. If it's at the beginning of each month, January, February, March. So Jan ka interest 250. Then on this 10,000 into 10% into 2 by 12, right? And 10,000 into 10% into 1 by 12. So interest is computed minus आ गया यहाँ पे, right? This so interest on 31st of March, this interest computation will take place, right? And the interest will be how much? All this add up करेंगे तो 500 rupees interest. So your balance will be in January, it will be 10,000. In February, it becomes 20,000. In March, it becomes 30,000. And then an interest is added 500 rupees interest. After March, it becomes 30,500. So next year onwards, in next year, 30,500 you will get interest for the whole year. So the compounding is happening only once in the year, as compared to monthly compounding. So 10,000 you will get invest in January. Then in January itself, interest is computed. So 10,000 into 10% into 1 by 12, right? So 83. So it becomes 10,083. Then in February you invest 10,000 again. So now it becomes 20,083. So uspe interest into 20,000 83 into 10% into 1 by 12, right? 167. It becomes now this 10,000 plus 10,000 plus 167, 20,000. Then next now again you invest 10,000, right? So interest will be on this plus this. So on 30,250. So 30,250 into 10% into 1 divided by 12. Sorry, 10,000 into 1 divided by, array, new block is gone. Now is into 1 divided by 12, right? So 252 again will be added. This plus this becomes 30,502 at the end of March. So if you see, it's little difference here, right? Little difference here, 2 rupees, but only in 3 months, right? So over a period of time, it becomes a big difference. So monthly compounding gives you this much. Yearly compounding will give you 30,500. Because every month the interest is computed, added, computed, added. Here the interest is computed at the end of the year only, right? So only once the compounding effect happens. Here every month the compounding effect is happening. So little difference now, but it will grow with time, the amount of difference, right?
Okay, sir.
So now 2 rupees difference is there now. 2 rupees extra you have earned in
Yes, sir.
monthly compounding. But over a period of time, that 2 rupees will become, amount is small now, 10,000. In lakhs of rupees, that comes 2, 3,000, 5,000, 10,000 very easily. So that's why the difference is there, monthly and yearly. So that's why we say payment is 12 times. Payment is 3 times, right? But compounding is once. Payment is 3 times and compounding also 3 times. So 3 and 3. That's what I'm trying to explain, right? So this is why monthly and yearly are important. In the long term, they give you very big effects. Short term may not so much effect, right? So this is your answer, 9898 and 9898. Now if I change this line, last line of next month, of every next month, right? Exact same question, but I've changed it from how much should you invest on the first day of every month, on the first day of every next month. So what it becomes now?
Sir, can you
That means
copy the
you're not start.
question?
This is the question.
No, just
First
make it
A,
a next line,
eh,
next, so that we won't be get confused. Yes.
this is A part, right? This is A part and this is B part. Same question, A part and B part. So A solution is this. This is your
Yeah.
A solution, and B solution is good on the side only. So it's comparable, right? So A and B. So A is the solution is this A, and now I'll do B,
Yes, sir.
right? B solution.
Thank you, sir.
B solution, I'll copy it again. Yeah, so B solution is this. Now what's the difference here? Can you even tell me what difference will happen? All the information is same. So what is going to differ by this one word next month? That means you are
Alternate
starting in
months. Alternate months.
alternate every next month. That means, see what it means. Okay, just a minute, I'm getting a call. See, sorry. So on the first day of everyone means, for example, he starts in Jan. On she starts with first Jan, right? First day of everyone means he starts when he starts investing from today. From today he starts first Jan, first Feb, first March. But on the first day of every next month, that means he starts 1 month late, right? Of every next month. Now this is a problem I've taken from some book only. It may appear to be a little confusing for you. You may interpret it as something like 1 month January, then if March, then something like that, but they what they meant to say here was, okay, on the first day of every next month, that means for today, if I am today in January, I will start with next month, the first February, then first March. So basically, what they are saying, okay, on the first of every next month means basically the end of every month. That means the mode we change from beginning, we change it to end mode. That's the only difference that will happen,
Okay.
right? Because first of every month means January 1st, February 1st, March 1st. Now, if I say first of every next month, so for January, first of next month is 1st February. For February, first of next month is 1st March. So basically, I'm just shifting the investment to the end of every month in in an indirect way, right? So just picture yourself. You are today in January. So if I say tell you you're going to invest on the 1st of every month. So 1st January you'll invest, 1st February you'll invest, 1st March you'll invest, and so on. So it becomes a begin mode question. But if I tell you you're going to invest on the 1st of every next month. So today you are in January, the 1st of next month becomes 1st February. In February, the 1st of next month becomes 1st of March, and so on. So what happens? Okay, you are actually doing end mode computation here, right? So 1st of next month means end of this month. 1st of next month means end of this month. So basically, the calculation will be in end mode now. Just because there's one word, now the same calculations, same thing, will be now in end mode computations. So I just change it to end here and change the type to 0. You see, a little difference has come out here. 9868 say it has become 9984. Here also you get 9984. Just need to change the setting from beginning to end and your type 1 to type 0. The remaining things remain the same, right? So just picturize yourself 1st day of next month. That means in January, 1st day of February, you have to invest. For February, 1st day of March, you have to invest. So basically, I have pushed the investment to the end of every month. So it becomes the end mode type of question. Very indirect way of saying it, but that's how they meant it in that question, right? So end mode computation we have to do. So whether if it's 1st of every month, you use begin mode. 1st of every next month, use end mode, right? In your computation. Although it's an investment, but they have specifically told you to use end mode. You have to use end mode. So sometimes the question can be a little confusing. So that really practice will come to know okay, what to do, right? So this is your one example of a question. I have done the that this next month as thing is over. Now one different kind of question. Now we have done investment. Now we have to see how much money we can spend every year. That's the question you have, right? Okay, how much I can spend if I have limited amount of money, for how many years I can spend how much amount every year so I can survive comfortably till my life expectancy, right? So let's say Mr. S is a coach, right? He wants to invest for his retirement. Sorry, retirement. He wants to invest for his retirement, right? He has 1 CR, 1 CR. He has 1 CR. Already has, right? He has 1 CR. Actually, the term I've used is wrong. He is what wants. He's planning for his retirement. He is planning for his retirement, right? So he has 1 crore now. 1 crore he already has. His expenses are he expenses are 5 lakhs a year. If risk-free rate of return is 4%, how long will he able to spend his money, this money, as he invests only in safe funds. Safe funds means risk-free funds, risk-free return. That's why we are giving 4%. Risk-free means safe investments, no risk of any loss or exposure, right? Government investments or savings account, something like that, right? So 4% he is going to get, right? He invests only in safe funds. He has 1 lakh rupees now. His retirement is on the way, and he has 5 lakhs a year expenses. So for how long can he pull on this 1 crore rupees along with 4% return every year? So for how long can he pull it on? That he wants to see. Okay, for how long can he be, you know, can he survive on this 1 crore with 5 lakhs expenses and no other income because he's retiring. So assume he have no other income. He has only this 1 crore rupees which he has got as a let's say a PF or maybe gratuity or something he has got from his employer. He left a job he got all his retirement proceeds from the employer. That came to 1 crore. Now he has 1 crore with him, and he has to spend his retirement age in this 1 crore. His expense are approximately 5 lakhs a year. So for how long can he be able to spend this money in this way? How many years will he survive if he spends 5 lakhs a year and invest only in safe investments, right? So if he wants to go in this way, if he wants to spend 5 lakhs a year, and if he wants only to invest in safe funds, that means he doesn't want to take risks. So for how long can he survive at this rate? That's what we have to answer here. So basically, they are asking us the time, how many years? Now it's 5 lakhs a year. So it's a PMT, but it's yearly. So we don't have to convert into months and everything here, right? So time we have to find out. That's not given to us. Rate is 4%. We can take directly 4% because now it's a yearly problem. We don't have to convert into monthly and everything. Present value, he has 1 CR with him. He has how much? He has 1 CR, which let's say he is going to invest now in the safe funds. So that's minus sign because he's going to invest it in safe investments, right? So he's investing 1 CR now. His payments are 5 lakhs. That means he'll keep on withdrawing 5 lakhs from that investment, right? Every year because he's investing 1 crore today, but he'll has an expense of 5 lakhs a year. So you have to withdraw 5 lakhs every year, right? He has to withdraw 5 lakhs every year because of his expenses. So 5 lakhs are coming in, withdrawing them, and then he uses for expenses, but he's withdrawing them from the investment. So money coming in because he will be able to spend that 5 lakhs only after he withdraws it. So withdrawing means money coming in. So 5 lakhs is a PMT with a positive sign. Future value is zero because he wants to spend the entire thing on his expenses only. He doesn't expect anything to be left out at the end of the time period. Type is now which type we will take. We will take as type 1 because normally for retirement investments and all we take begin mode by default, right? So begin mode type 1, right? Here also begin mode in calculator. By default we take begin mode unless mentioned in the question. For loans and EMIs we take end mode. So NPER is how much? What's the formula? NPER, right? Bracket open, rate, comma, PMT, comma, present value, comma, future value, comma, and type is 1. That's around 37.38 years. Approximately 37.38. You can convert 0.30 into months. Will come to around how much? 0.3868 into 12 if you do. It comes to around 4.64 months, right, approximately, right? So 37 years and 4 or 5 months approximately he will be able to survive at this rate if he spends like this. So if he is planning, let's say if he is 60 years now and if he expects to live till 90, that's the average life expectancy. So he may have to little curtail his expenses so he can carry on for 40-45 years more, or he has to invest in a higher amount of rate of investments. That way you can plan his investments. If you invest in 5%, maybe if I take that 5%, you'll be able to carry on for next 62 years, right? Without any tension. But if you continue investing in 4% investments, safe investments, then you won't be able to survive more than 37, 30, 38 years. Right. So begin mode where we have completed this thing. On the Calci also, same way, no difference. There's no difference at all on the calculator. Same thing you'll get, right? 4% you write only 4 here, not percentage. So you have to write in 4, only 4, right? Then this will be the same answer, 37.868 you'll get, right? Same PV, same PMT, type also not there on the calculator. And this is also 1 and 1 because there is no monthly compounding, there is no monthly payments. So 1 and 1, right? There is no monthly compounding, yearly compounding and yearly payment. So 1 and 1, right? So if you get the same answer on the Calci as well, 37.868. So this was a question where you have to find out कि how many years he will survive if he continues his spending habits in this way and continues to invest in safe funds, right? So it was like a case study, small case study above question, right? Now we come to the loan part. So let's say Mr. K takes loan of rupees 40 lakhs at 12% per annum for 20 years. He, now this is an interesting question. He took the loan money in 2 years in equal installments. Calculate the final EMI. Calculate the final EMI. Now, this is a not a regular loan question which you've done before, right? I just changed it to 11% because I have solved it before 11%, so I have the answer, right? So 11%. So this is a loan he has taken. Let's say home loan, business loan, whatever loan, but he has taken a loan of 40 lakhs for 20 years. He's going to pay back the money. But your loan money hai, he has not taken 40 lakhs one shot. He took 20 lakhs first and then 20 lakhs again from same bank, from the same bank. So he took the loan money in 2 years. So year one he took for 20 lakhs, year two he took 20 lakhs in equal installments. Right? Sometimes it happens that the loan money is not given in one shot; it is given in stepwise, right? In a stepwise format. So 20 lakhs in first year he got, then 20 lakhs in second year he got. So you have to compute the final EMI. That means for these two 20 lakhs together from the third year onwards, how much EMI he will pay every month. That's the question, right? If it was only one time loan, 40 lakhs, then you could easily find out PMT formula. Okay, you could have found out the amount of EMI. But here, there's the loan is in two parts: 20 lakhs in the first year he got, and 20 lakhs in the next year he got, right? So you have to find out the final EMI he will be paying after the second year. From the third year onwards, or from the second year onwards, what is the final EMI he'll be paying for both this 20 lakhs together, right? So that's you have to find out. Now, for loan questions, we had written down two assumptions before. There are two rules, rule number one and rule number two, which you have to assume for any loan EMI questions. The first rule is that monthly compounding is there by default. Loans are always monthly compounded because that gives the bank higher amount of interest, right? So loans are always by default monthly compounded, right? So every month interest is being computed. Every month interest is computed, compounded, computed, compounded. So your effect is much higher. So that's why you end up paying more amount of interest. Right. So normally the interest rate on loan which is given is a nominal rate. You have to convert into effective rate. If you are taking a loan tomorrow, don't believe 11%. 11% is a nominal rate. You have to convert 11% to effective rate. Right. So if I convert into an effective rate, let's say effective rate 11% monthly compounding. Well, it comes to how much? 11.57% is actually the loan amount, interest amount, 11.57%. So don't get fooled by the bank, right? Whenever the bank tells you 12% is the loan interest, you convert that 12% into monthly compounding effective rate. 11, so it will be more than 12%. 0.5%, 0.6% extra हो जाएगा, right? So that people can't understand who don't know this thing. So this is actually not 11%, it's 11.57%. That's the effective rate which they are charging you every year. But the rate given by bank is always the nominal rate. That means always is monthly compounded. Never it is yearly compounded. Right. So that one assumption we have to make. And the second assumption we have to make is we have to do the end mode always for loan computations. Loan and EMI always do end mode by default. So any EMI loan question, you have to do these two assumptions by yourself. They won't tell you, right? So monthly compounding and end mode, because that's how banks normally follow. 90% of the banks follow this only in their loan computations. So you have to also know this, right? So whenever you take a loan in future, you take this into consideration and then evaluate the banks which is giving you the best amount of deal, right? So rule number one and rule number two. So now there are two ways of solving this question. Two ways. There are two ways. I'll do both ways, right? There are two ways. One is you treat both of them as separate loans. 20 lakhs separate loan, 20 lakhs separate loan, and then you add the EMIs basically together. That's the easy way of doing it, right? So let's say I copy this here. I'll do for the first loan of 20 lakhs, right? So set is now I'm doing only on the Excel sheet because it's not required. Okay, I'll do it in the Calci also, both on the Excel and the calculator. So Excel and Calci, right? So by default end mode that means type 0, right? Uh, what is on the time period? It's 20 years, right? Now it's EMI means monthly installment. So you have to convert number of years into months. So 20 years into 12 months per year. 240, right? 240 months, 240 months. Rate, as I told you, it's monthly compounded. So the rate is by default a nominal rate. This by default is a nominal rate, although nothing is given here. But by default, it's nominal rate monthly. So you read this as 11% per annum monthly compounding. Nothing is given. Still, you read it as 11% per annum monthly compounding. This is the nominal rate itself. So, but converted to monthly rate, it's simply 11 divided by 12. That's 0.91, and I convert this into percentage, right? Sorry, 11 percentage. Okay. So I'll convert this into percentage format. 0.92%. That's your monthly rate, right? Since it's by default nominal rate, you can directly divide by 12, get the monthly rate. So that's your rate. Now for Calci, you don't need to convert. You can take 11% only as it is, right? Because we can use a CYPY here to convert this. Present value, what's the present value? You're taking a loan of 20 lakhs. So the present value is you're getting something, right? So 20 lakhs is your present value. You're getting 20 lakhs today from the loan, right? 20 lakhs is your present value incoming. PMT we have to find out. EMI, PMT basically in this case means the EMI we have to find out. And future value will be zero. Because when the loan and at the in the future at the end of 20 years, nothing is left of the loan. So future value should be zero. Here also future value should be zero and 20 lakhs is the amount of present value. The only difference here is in PY and CY, what will we do? Monthly compounding by default and monthly payment also because EMI is always obviously monthly. So 12 and 12. Now we solve the formula here. So PMT is equal to rate NPR PV FV type. We get 20,643 as the EMI he is going to pay every month. So this EMI you have to pay for every month for 20 years. For this 20 lakhs loan, you also get the same answer 2643.77, right? But your convenience क्या है यहाँ पे कि you can use the rate as given in the question, simply do changes here, right? Whatever rate is given in the question, just copy it here and then do changes here. If it's monthly compounding and monthly payment, 12 and 12. It's monthly payment and yearly compounding, 12 and 1, right? So that automatically will adjust the rate, right? So that's your first loan. Now the second loan, second loan of 20 lakhs, which you take after 1 year, because he took the loan money of 40 lakhs in two installments. First in 20 lakhs in 1 year, 20 lakhs in second year. So the second year 20 lakhs, which now he's taken. The amount is same, 20 lakhs. The rate also same. Everything is same. But the time is now 12 months less because the first loan he took for 20 years. Now the next installment at first 20 lakhs is for the entire period 20 years. The second 20 lakhs he took 1 year late. So for that he has only 19 years, not 20 years. So 19 years into 12. That's 228. Here also 228. Remaining things remain the same. So what's the total EMI he'll pay from the third year onwards? This
Something I think
plus
so. It's 0.96. It's not 0.92.
which one?
Yeah, the interest rate for both of it. Once can you
0
check it?
point
96, I
is
think so.
no, this will remain the same then because we divide by 12.
Yeah. 11.57 divided by 12, right? Could you do that once? 11.57 divided by 12. That would be 0.96, I think so.
Huh. So it's 12% like in this case, 12% per annum monthly compounding. So that is your nominal rate. So we divide by 12 only to get the monthly rate. When the effective rate is given in the question, then we convert it to nominal rate and then divide. Right. So here also, like this question, 12% per annum monthly compounding. And here also in the loan question, we assume that the the interest rate is monthly compounding. So it is 11% per annum monthly compounding. So it's the effective nominal rate itself. So we simply divide by 12. So 11 divided by 12 will give you 0.92. This is the effective rate. I just showed
Oh,
you for your knowledge. If you take a loan from the bank tomorrow, so always don't believe the rate which they tell you. You have to convert this into effective rate. That's the actual expense for you as a person, as a loan taker. Right? So if this was given 11.57% effective rate, right? So we have to convert this in nominal rate and then divide by 12. But here we are directly given the nominal rate only because in loans we assume that the rate is nominal. That means it's monthly compounding. So 11% per annum monthly compounding. That's what you have to assume. So this becomes the nominal rate. Divide by 12, you get the monthly rate. Just write it down
got
somewhere. Okay, you can only divide nominal rate by 12. You can't divide the effective rate by 12.
it.
So if effective rate is given to you, you convert to nominal rate and then divide. But if nominal is given to you ready-made, then just simply divide by 12. Okay, got it, no? So
Yeah, I got it. Thanks.
this is your thing. So now what's the EMI you'll be paying? This plus this. Sorry, I have not changed this. Uh, I have to copy the formula here. So this is your changed figure, 20.949, right? So minus 2949.28. So little change in EMI, 2643, 2940. Why is it increasing? Because the time is lower. Here we had 240 months. Here we have only 228 months. So little more EMI you have to pay for the second installment of loan. So total 40 lakhs you have taken. 20 lakhs in first year, 20 lakhs in second year. So 40 lakhs loan you have taken, and for that a combined EMI you have to pay off for 41,593 rupees every year from the second year onwards. Right? First year you only pay 29 this much only first year because only 20 lakhs you have taken. In the next year you take 20 lakhs more. So you have to pay this plus this for 41,593 from the second year onwards till the 20th year. You have to pay 41,593 rupees every year as your EMI. That's your final EMI. That means after the second installment you take, how much EMI you have to pay every month? Sorry, 41,593. We assume that okay, he took the loan money at the beginning of first year, 2 lakhs, at the beginning of second year, 2 lakhs, right? But EMI is always on the end mode. EMI you pay at the end of every month. End mode matlab EMI is paid at the end of every month. And that's by logic because see, if today you take a loan, they won't tell you to pay EMI upfront, right? They will tell you you pay the first EMI after 1 month, right? Normally what they do, they adjust their charges or something in that first month. The bank charges also there, which is we are not considering here. That also will get added to your actually loan amount because that also you have to pay. But sometimes what they do, they charge you something, then they take some, they make some adjustment, they give you some discount, they charge you, and they adjust that bank charge against the discount. So that gets off in that gets set off, and then the original principal remains as it is. So if you have seen the EMI statement anytime, if someone has taken loan, just study it. You'll come to know, and then you try to calculate this way, right? Take anyone's loan statement in your office, your friend, your father, your uncle, and try to compute the EMI in that loan. See whether you're getting the same answer. Maybe you get some little different answer because there will be some bank charge or something, or some prepayment charge will be there, maybe in their case. So maybe some difference may be there, but 98% you get the same approximately answer, right? So you just try it out that way. Compute the PMT, that is the EMI, in your practical scenario, if you can, if you have any. Or this is also very good. If you want to take a loan tomorrow, you can just ask bank the rate of interest and time period and the amount of loan, how much you want. So based on this, you can compute the EMI yourself. So how much you have to pay every month approximately. Maybe the bank computes, they'll get 100 rupees here and there, maybe, but approximately you'll get the same amount of EMI, right? So you get an idea before you take a loan. You can just check whether your computations and your bank computation matches or not, right? So sometimes there are some hidden clauses in the loan agreement which you don't know. So by that you can catch that. Okay, why we computed, we got so much, they compute, they got more. So what's the difference here? So that some hidden clause or some hidden agreement will be there which you don't know of, that you can find out that way, right? So all this is very useful in practical things also. Now this was one way of doing it. Now I'll do show one more way and then we'll end. right? How the bank will do it, how the bank computes it. What the bank will do, they will take 20 lakhs for 1 year, first of all. So the first part will remain the same, right? The first part they will take the same only, but they won't take it for 240 months. They will take it for 12 months. How many? The first year, only the first year, 12 months, right? 12 months. Only the first year, right? 12 months. So, sorry, it's number of okay. So what they will do, right? Okay, they will take this 20 lakhs. Now this computation is a little difficult because it's not going to be what you will do as a student, but what the bank will do, that you have to find out here. So what they will do now, be with me. Last thing. Now what they will do, first of all, they will compute, let's say, for this 240 months, the first year. The first year will get over where you'll be paying 20,643 every month, right? So they will first year they will compute the EMI like you only. They will compute 20,643 only for the first year, the EMI for first 12 months, right? So you will pay 20,643 into 12, right? So how much you will pay to the bank? You'll pay 20,643 into 12. You'll pay this much amount to the bank, 24,776 approximately you will pay, right? Then what will happen? Okay, after 1 year, you you will take one more loan of 20 lakhs, right? So what about the principal amount of the first loan? How much is left out of that loan, right? So if I compute that, let me compute that. So if I compute that, let's say I compute this in that table format, right? So 20 lakhs is your loan amount, outstanding loan, and the interest is how much? 11% per annum monthly compound, right? So 11% divided by 12, 1 month per month, right? This will get added as the interest for the first month. End mode, you know, the interest for the first month will get added. The bank will add these two. Then you'll pay the EMI, right? 20,643 you'll pay, right? So it becomes less than this minus this. So balance becomes 1997690 at the end of first month. This way you have to do for 12 months, right? So 1, 2, so 1 and 2. I'll copy this down to 12, right? So 20 lakhs was the original loan amount. Interest got added 11% for 1 month, right? 11% for 1 month. These two got added. It became this much amount. You paid EMI, right? 20,643. What was the exact amount? 20,643.77, right? 20,643.77. So it became this much, right? I'm just rounding off the nearest. Hmm, right? Just rounding it off. So this was what happened in the next period. This became the opening principal. Again, interest. Again, you pay the EMI. Again, same story. So copy, paste. Little less interest because amount is less. You pay the same EMI again. This becomes this way. And then I copy this over 12 months, right? Over 12 months, I copy this. So after 12 months, your balance is about 197, 19 lakhs 70,833. You have paid interest of this much amount. You have paid interest and you have paid the EMI. So basically, 20 lakhs minus 19 lakhs 70. How much actually principal amount you have paid in 1 year? Only Only this much you have paid. Rest you have paid interest only, right? Rest you have paid interest only. This much interest you have paid. How much? 2,18,000 interest. Only 29,000 principal, right? 2,18,000 interest you have paid. The remaining is principal amount, 29,000. Because out of 20,000, 18,000 was interest which you are paying, right? The loan amount is huge, right? So 11% per month is also almost 20,000, right? So that's the principal amount you have paid. So the balance is this much after the end of 1 year. Now you take one more loan. You take one more loan of 20 lakhs, right? You take one more loan of 20 lakhs. So becomes how much? It becomes the opening principal for the next year becomes this plus this. So it becomes 39 lakh 70,000 now, right? The loan amount, principal amount. So what you will do? So this you computed for this year. Now I'll copy this again for the next 20. next term. So now we have how many? We have 228 months more. Okay, rate is same. Now the amount is present value of this amount is 39 lakhs 7833, which is the present value of the loan as in the beginning of the second year, right? So see the same amount you're getting 41,503, 41,500, but this is the final amount. From this year, from 13 lakhs till the end, you keep on paying 41,503. So for the first year, you will pay 2643 every month. From the second year onwards, you will pay 41,493, right? So that's how the bank will compute your EMI, right? That's how they will do it in the computer because they for them it's one loan, so they'll have only one loan account. So after the end of 1 year, your loan balance was 19 lakh 70. Then you took 20 lakhs more, so it became 39 lakh 70. So the present value of the loan today is 39 lakh 70 at the beginning of the second year. So at the beginning of the second year, the present value is 39 lakh 70, and that you have to pay in 228 months, right? 228 months at this 11% per annum monthly compounding. So how much EMI you will pay? 41,590. The same thing you can get in two different ways, but I would prefer this way, right? This is the this is the better way of doing the thing. Very easy and very fast, right? This also can be done in this way, but I wanted to explain to you okay, how the EMI works, right? This way. So actually, you are paying a large the interest will be very large in the beginning. So whenever you observe the EMI schedule, the interest amounts will be the highest in the beginning few years and the lowest in the last years. So in the beginning, 5, 6 years of loan, you're just simply paying the bank interest only. Principal amount will be very low. See, after 1 year also, from 20 lakhs, it's become only 19 lakhs 70. So you have hardly paid 29,000 in 1 year, right? The remaining you're just paying interest to the bank, right? So that's why it takes a long time for even a 20 lakh loans, you need 20 years to finish, right? Because the EMI is so taxing, the interest amount is so taxing on. And nowadays, 11% is a common rate. Nowadays, you can find business loans and personal loans up to 12, 13% also interest they charge. So just see the amount of money they are earning from you through the interest, right? So that was about the loan amortization schedule. This is called as the loan amortization schedule. I can make the entire thing also. If I just make it from here, 13 months, I can stretch it to 240 months and finish it off entirely. Right? It's very easy. I can do it this way. See, this I copy, this second line I copy, right? And I push it here, right? And then I copy this for how many? 200. I just copy it for 200, right? So let's say copy it for as high as 2. Just wait. Let's keep on copying this, right? So this is sorry. This is like this plus this. This is this is this plus this. This is only this. Now it will come proper. So I'll copy this line for let's say 613. I have to go till how many months more? I have to go at least 200, 228 more. So up to 613 plus 228 if I do, it will come to approximately 840. So I'll just copy this thing till 840 and see whether I get a zero in the end, right? Let's stretch it out for the 840. 840, 840. Okay, let's see. No, still going that way. Some error coming. Number is correct. Let's see. So 39 lakhs 70,000 is the amount. Then we take interest at 11% per annum. We add them up. The EMI is different. Na? We have not changed the EMI amount. It is how much? 41.41593. We will change this also. So 41,593, right? And copy it across, right? So almost we have reached the end. 35. Almost reached the end. Maybe we'll add one more line to it. Let's say no, 35 is the rounding off, right? In the end. So 35 is almost the end of 35 rupees round off here and there because of uh, we have rounded off the things also. I've made this 41 point. This should be 41,593.07. So if I had made an exact figure of 41,593.07, then it would be perfect, right? So if I just make it like this until the end, see, almost 19 tak pahunch gaye. So that's how you can make the EMI schedule. Just 2 lines you have to do properly, the first 2 lines. Then you copy it throughout. Copy the second line and copy it throughout till the number of months you require, right? So, and the end you should get a 0. That's called as a loan amortization schedule. So that's what the bank gives you when you take a loan, right? So if you change your EMIs midway, they will restate the schedule and give it to you. Or if the rate of interest changes, sometimes there's a flexible rate of interest. So if the rate of interest changes, they will change the interest rate here in the formula and then give you the schedule again, right? So this is called as the loan amortization schedule. In the end, it should come to very small figure, 20, 30 rupees, right? Or 0 also sometimes. So if it's because of round off, it doesn't go exactly 0, but that's okay. Even in the bank schedule, you can sometimes see 5, 10 rupees at the end, which they waive off in the, they don't take from you. They waive it off. In bank charge something, they waive it off there. So that's your loan amortization schedule. And with that, we end today's session. Right? So now you know how to make a loan schedule by yourself, right? Which you can try it out in practical life. Whenever you have to take a loan, just try this schedule out by yourself. So this will help you out in determining the EMI, the period, how fast you're paying the loan, right? You can just twist things here, increase the EMI and see, increase the rate of interest, decrease rate of, and just check it out, how what changes happening, right? So you can play about with it as much as you want, right? So that's it. I'll conclude for today, right? And we'll continue again on next Thursday, on Thursday, right? Till then, stay safe, all of you. Hope you enjoyed this lecture, and it was enlightening to learn something. I'm also learning with you actually, right? Because the more you teach, the more you learn also. So every time I teach someone, and I also learn something new, right? By teaching, right? So it's a win-win situation. Hope you enjoyed, all of you, and
Thank you, sir. Good night.
good night, all of you. Good night. There's one person missing, I think, today. No? I think Tanushka is not there. And she said she watched the videos, so okay. Thanks,
Thank you.
Nikhil. Thanks, Hitesh. Thanks, Tanushka.
Thank you, sir.
Thank you, Savita.
Thank you, sir.
Thank you. Good night.
Yeah, good night, sir.
Night.